to one and all. On behalf of Meghnad Desai Academy of Economics, let me extend a warm welcome to Dr. Chiragra Chakrabarti and thank him for being with us today this evening in spite of his busy schedule. Um, I know it really took quite some time for us to fix a date because he's extremely busy. So, I mean, it's nice of him to finally find some time for us. So thank you once again, Dr. Chiragra.
Thank you so much.
Yeah. Let me introduce you all, the today's guest speaker, Dr. Chiragra has completed his doctorate in finance from Mumbai University and has rich experience of working in capital markets and financial markets of different countries for more than 25 years. He has been member of various committees constituted by the Government of India, Reserve Bank of India, Asian Development Bank. He has worked closely with capital markets of South Africa, Mauritius, Botswana, Namibia, Ghana, Nigeria, and Kenya. I think it's going to take quite some time for me to really give you the introduction, but let me mention a few more achievements of today's guest. Currently is the founder CEO of Katik Consultancy and is based in Mauritius and has joined us from Mauritius. Before that, he's worked in capacity of being a director at Deloitte, PwC, and Nomura, and I think the recent one, the director of Bank of Mauritius. So we are really honored to have you with us with such a rich experience. I'm sure uh, it's our privilege to have you with us and that you have giving some time for our students. So thank you so much. I request you to address the students.
Thank you so much, Dr. Bhageshri. Good evening, everyone. I'm really honored to get this invitation because Lord Meghnad Desai is a very big name in the world of economics, and I'm also very privileged to know him personally. So that's as a great person, a great economist. So when I got this offer, I was very excited to come and speak to students, because I've heard about this organization or this institute from various people, that this institute is doing very well in Mumbai, and I was very keen to address this part. Since Dr. Bhagyashree has already introduced me, which is so nice of her, that I don't have to, then I can skip few of my initial slides, which I thought, because generally nowadays we don't receive so much of introduction in institute. People say speaker will introduce themselves, but it was so nice of Dr. Bhagyashree that she did that. And so I will skip those slides, but it will be there for you all anytime, specifically if you want to connect me anywhere, so we can do that connection. So today's session is about IBOR Transition Program, and I will speak around 45 minutes, which I've been told, and then I leave this floor open for question answers, because I think this is a topic which is very live now, because this is happening now in the global world, in the global financial world. And many things which is being, we are trying to do it, it is not available in textbook nowadays, because it's absolutely happening now. So when Dr. Bhagyashree told me to select a topic, I thought, let me speak on this to you young student and get your feedback, that what you think on this, because this is a big change which is happening in financial market or financial industry. So IBOR Transition Program, what is it? So we'll talk about that in due course of time. Sorry. So I'll skip these slides, which is there for you. This is my CATIC and some of the clientele. I'll not bore you with those parts. And let me speak straight away from IBOR transition perspective. So when you talk about IBOR, it is basically, we are talking about various market benchmark and specifically the global benchmark, which is Libor. And we'll talk about that what is the issues which we are facing now, and what will be the new things which will be happening in the financial world. So as we talk about here, specifically when you talk this thing, let me start with the concept of LIBOR. And I'm sure you people must be knowing about LIBOR because you are doing finance, but still just to bring everybody on the same playing field, I thought let's start with this, that what is LIBOR is all about. And so as we know, LIBOR is the acronym for London Interbank Offer Rate. So basically it is a rate at which most of the banks in the world, they borrow and lend for a short-term period. So it is between 0 day to 1 year. That's the way in between they borrow and lend. So if one bank wants to borrow from another bank for 1 day, 1 month, 6 months, 9 months, 12 months, they use the benchmark rate, which is the LIBOR. The history of LIBOR is pretty old. It started in 1969 when one of the Greek banker named Minos Zomanskis, he created this concept of LIBOR for a syndicate loan. That means when few banks coming together and giving a loan to somebody. So from there, it took up and it became one of the biggest liquid global benchmark in the world, that is LIBOR. Now, as we said, LIBOR is London Interbank. So basically it started the London Interbank. It is basically a few panel global bank. They used to give quotation in the morning, and based on that quotation, a benchmark was decided around 11 o'clock in the morning, and it was to be announced. And globally, people is to take that rate to borrow or lend in the interbank market. So it acts as a benchmark for short-term interest rates. It is an indicator of the health of the financial system, basically because LIBOR also gives a benchmark. If the LIBOR is going up, that means we say the interest rates in the economy is going up because there can be liquidity has gone down, maybe various reasons why, macroeconomic factors which can push LIBOR up. Or when LIBOR goes down, we say the interest rates are going down, which is the scenario now. So LIBOR is the biggest benchmark which is being used still now today as one of the global benchmark for interbank market. And it also is being used in other financial markets because various financial products are linked with LIBOR for valuations and other things. So it is a benchmark. LIBOR is administered by Intercontinental Exchange or ICE. They are the regulator. It is computed for 5 currencies. So you have LIBOR on 5 currencies, that is on Swiss franc, euro, pound, sterling, Japanese yen, and US dollar. And it has got 7 different maturities, which starts from overnight, goes up to 1 year, 1 month, 2 months, 3 months, 6 months, and 12 months. Now, this I'm talking about LIBOR, that is London Interbank Offer Rate. But I started my session by saying that it is an IBOR. What is an IBOR? So it's an interbank offer rate. Now, why I said IBOR and what is the difference between LIBOR? Because LIBOR is on these 5 currencies which you talked about. But interbank offer rates are there more than those 5 currencies. If for a nearest example, which I can give it to you people is, you have something called MIBOR in India. You also have something called MIFOR, which is in India. This is also interbank rate, and that's why it's called IBOR. So in different currencies, we have IBOR in local currencies, but 5 major currencies, which is we just talked about, that is called LIBOR. And why this LIBOR is so important? Because globally, major transactions are taken on LIBOR. But when you talk about let's say rupee dollar, you'll be talking about MIFOR, that is the local benchmark, which is for India. But in India also, if a bank is trading on dollar, it's trading or taking a loan on dollar or giving a loan on dollar. If it issuing a bond on dollar, so it will be maybe using LIBOR as one of the benchmark, LIBOR USD. If it is doing on GBP, it will be using LIBOR GBP. So depending on currencies, the name comes up. So LIBOR on all those 5 currencies. But I started by saying IBOR. It's not a typo. It is typically, it is saying interbank offer rate. And each country has its own IBOR, which is as I gave the example, in India, you have MY4, which is for USD, INR. So that's the concept of LIBOR. And as I said, this was basically taken into consideration by a survey. So every day morning, ICE is to send a questionnaire to major banks sitting in London. So that is the panel they have created. And they used to ask the banks that at what rate you can borrow today. That's the question which was asked. So the banks will say, okay, this is my borrowing rate for 1 day, borrowing rate for 1 week, 1 month, so much. So ICE is to calculate, take all the rates together from different panel banks, and then they used to do weighted average, trimmed weighted average methods based on it, which is to come out with a LIBOR every day, 11 o'clock in London time, which is to be announced, and it is to go across the world for those 5 currencies. And that's the history, which you all know. But the problem is now this nearly 800 trillion financial instruments are linked with LIBOR. And this is not a small amount, as you can see from here. This is absolutely a pretty big amount, which is we can think of. So you see, this is around 800 trillion in financial instruments which are linked with LIBOR, which includes, as I said, corporate debt, mortgages, student loans, interest rates loan. And out of this 800 trillion loans, around 350 trillion loans are 350 trillions are linked with derivatives, financial derivatives. So you can understand the weightage of this LIBOR. It's so big because the amount of financial instrument linked to LIBOR is around 800 trillion. So as I said, the usage of LIBOR was in 2 primary purposes in modern market: as a reference rate, as a benchmark. So it's a reference rate because we refer LIBOR with something, the interest rates going up, going down. It's a benchmark rate also because I benchmark the economy to that. I benchmark my valuations of my portfolio to it. I do my valuations of my financial product linked to LIBOR. So it's a reference rate as well as a benchmark rate. The important part on this slide, which you should now get into this little bit of technical bit of it, is that when the LIBOR was quoted by the banks, it was basically quoting 3 things in this. One was, it was a summation. It was one word, let's say one figure, which will be a summation of the overnight risk-free rate plus the term premium, that is the premium which is linked to the term of the rates. So 1 year has a different premium, 6 months will have a different premium, 3 months will have a different premium, 2 months, and so on and so forth. So the term premium plus the bank term credit risk. That is the credit, since the question was asked that at what rate you can borrow. So definitely you need to add a credit risk part because the bank can get default. So that's why these 3 things was taken into together, and the banks is to quote for LIBOR. So LIBOR is a summation of overnight risk-free rate plus term premium plus bank term credit risk. So this is, you should keep this in mind going forward because this is the exact technical definition of a LIBOR. It is the overnight risk-free rate over the term plus term premium plus bank term credit risk. Now, there was a big scam which took place in LIBOR because since it was a market perception and the quotations were given, so after the 2008 debacle, financial debacle, many banks manipulated the LIBOR for their own purpose, own portfolio. So, so I'm not going into that details because that's a huge subject to talk about. Maybe we can, whenever you have some time, we can discuss that. But it's basically that scam took place, and it was identified. Some of the banks were paid a fine heavily for that, and And the weekly review committee, which came out to review this scam, they came out with 3 suggestions, basically. They came out with 3 suggestions. And this 3 suggestion is changing the world today. The first suggestions, which was said that the governing responsibility of LIBOR should change. That means the whoever is the owner of this benchmark should be a complete neutral party, and should not get influenced by market participant. Second thing, it was saying that since LIBOR was quoted by the bank, it was not based on actual transaction rate. It was basically a forward-looking. Whatever the perception of the bank was, they used to quote, not exactly based on the actual market transaction rate. That means is that if somebody asks me today, I'm a banker, and someone asks me that what is my quote will be for one day, so I'll quote it, but this is not based on actual transaction, and that's my perception, my forecasting, my analysis. Based on that, I'm quoting that one day rate should be this. But if somebody asks me, no, you quote me based on yesterday's, whatever the transaction was done, based on that you quote, then it is a transaction-based quotations. So LIBOR was a perception-based quotations and not a transaction-based quotations. So this committee said, no, going forward, benchmarks should be transaction-based quotations and not a perception-based quotation. And third thing came into picture is that the local regulators, that is the local central banks of the respective countries, will have power to penalize the bankers who will be manipulating with the benchmarks. So these are the 3 things came into picture. One was the governing, the ownership structure of benchmark should change. The benchmark should be based on actual transactions and not the perception. And the third one is that the local authorities can have power to penalize the local banks if they do manipulation with the rates. So these 3 things made a lot of changes, and based on these recommendations, the new things are happening. And what is the new thing is happening? The new thing is happening is that the Financial Conduct Authority of UK, who was basically because LIBOR was basically from UK, has said that LIBOR will not exist anymore after 31st December 2021. So that means 800 trillion financial instruments which are linked to LIBOR will have to be remediated. That means you will not have LIBOR linked with GBP, linked with Euro, linked with Swiss franc, linked with Japanese yen, and linked with 1 week and 2 month US dollars. The last date for this is 31st December 2021. So that means from 3rd January, some other rates has to be used for the banks, financial markets, everyone, whoever is using this floating rate. The rest of the 10-year of the US dollar will be there till 30th June 2023. So other than the 1 week and 2 months US dollar settings, the terms, others of the US dollar will be there till 30th June 2023. But the major important part says that the rates which will be there, the USD dollar rates which will be available after 31st December will not be allowed for any new products. It will be allowed only for the old products which was existing before 31st December. So technically speaking, for any new products, 3rd January onwards, 3rd January 2022 onwards, the benchmark rates will be absolutely new and LIBOR cannot be used for that. Another thing which also as a finance student you should understand, since this LIBOR was based on survey of the banks, as you are not allowed to do a new product on that benchmark, most of the banks will not be in a position to quote that. And slowly what will happen, even technically is saying that 30th June 2023 is the deadline for US dollar LIBOR, but 3rd January onwards, you will see that liquidity in the LIBOR is going down because there will be no quotation there. So what I read from here itself is that going forward, the 3rd January 2022, technically should be a new benchmark should come and LIBOR will not be available so efficiently. So it will not be available for sure for pound sterling, euro, Swiss, and Japanese yen, but for the dollar also it will be very illiquid. So all bankers across the globe are now working on that this transition should happen quickly, so that that people should not have any problem. And you should understand that, as I said, there's a huge amount of financial products which are linked to it. Those things require a remediation. What remediation means? That all these products should be transferred to the new rates. And there is no guarantee the LIBOR rate and the new rates will be the same. So there can be differences there. So the counterparties, the investors, they need to get convinced, because if they start making losses, then they will not get convinced. If the bank starts getting losses, they will not get convinced. So there should be a negotiation coming there. So there's a tremendous remediation process which is going on now with all major banks, that's why this is called IBOR Transition program. It is changing from IBOR to the new benchmark rates. Now, since I've said this, so what is the new benchmark rates you have? So that question can come to your mind. So the new benchmark rates are these. These are the typical risk-free rate. Risk-free rate are the spot rate, which is going to be used now in place of LIBOR. Now, the risk-free rates are for dollar, it is SOFR, which is based on the day before yesterday's rate. So if you ask me today's SOFR rate, I'll say Friday's SOFR rate will depend on Thursday's transactions happen in the United States of America. And this is basically based on the repo rate. And that's why it's a more secured rate, they are saying. So SOFR is the benchmark which will be used for dollar. SONIA, which will be used for GBP. Toner, which is again a risk-free rate, which will be used for Japanese currency, that's yen. Eurostar is another currency which will be used for euro, but Eurostar also have another benchmark, at least for next 1 year, which is called Eurobor. So the portfolio which has got euro can have two options for remediation. One is the Eurostar, another one is the Eurobor. Australia also is coming out with its benchmark EONIA, and so forth. So these are some of the replacement which is coming, which will be replacing LIBOR. But these are risk-free rates. So you cannot compare LIBOR and RFR. It's not apple to apple. It is, one is apple, another one is orange. So you cannot just compare that, and it requires some sort of remediation which is to be done. So alternative rates, as I said, so far, it is secured overnight financing rate, is a broad measure of the cost of borrowing. So it's basically, obviously the slides I'll share with you, so I'm not reading this here, but this is basically a collateralized rates, which is based on the US market, and it's owned by Federal Reserve Central Bank. So thus, as I said, the ownership is very safe. It is based on actual transaction which has happened, so it is also good. So that is not a perception based, but it's an actual transaction based, and it will be released by the central bank, Federal Reserve, and it will be released at 8 a.m. Eastern time, which is around 5:30 p.m. Indian Standard Time. SONIA is the Sterling Overnight Index Rate. It is for GBP, but this is not secured because this is based on call and notice money, and it is to be used, it will be released by Bank of England, and Bank of England will be releasing it at 9 a.m. UK time, which is around 1:30 p.m. Indian Standard Time. Toner is the Tokyo Overnight Average Rate. Eurostar, as I said, this for the euro, and the EONIA for the Australia. So these are the different risk-free rate which is coming. Now, another thing which is you must have seen that I have given the time, because LIBOR we have released it one time. Now we'll have a different time segments for the risk-free benchmark rates. So that's the one issue which is, it's not an issue for a human being, but it's an issue for if you have a technology which just take the rates from the Bloomberg or Refinitiv or from the central bank directly with the APIs between your core banking or a treasury system, then you need to create that the algorithms in such a manner that it should take those different times, the rate should be picked up. So that's why I specifically mentioned this rates will come out at a different time, and that time it needs to be picked up for your valuations of your product, for your all the requirement for which the LIBOR was to be used. This will be used now. So what's the key difference between LIBOR and ARR? ARR is the alternative risk-free rate. So alternative risk-free rates relies entirely on the transaction data, whereas LIBOR or IBOR is based on partially, I'm still using the word is because still it's existing, is based partially on market data because that gives the perception, and partially on expert judgment. So it's a judgmental quotation and not actually based on the transaction data. Like, for example, if you're creating an index, like if you have Sensex and Nifty in India, those are based on actual transaction. So that's the alternative risk-free rate, which is also talking about. ARR is a spot rate. So it's as a spot rate means it is the rate as on today. Whereas LIBOR, as I said, it had a different terms. So it was a spot rate, it was basically overnight rate, it was 1 day rate, it was 6 months, 3 months, 9 months, 12 months. So different terms were there for LIBOR. So LIBOR was a forward-looking rate. So you know from today itself, if we are in a LIBOR curve, that what will be the 3 months LIBOR, so you know. What will be 6 month LIBOR today, you know. What will be the 12-month LIBOR today, you know. So it's a forward-looking curve. But ARR are basically a SOFR, which is one of the example of ARR most commonly used now for US dollar, is our backward-looking rate because they will be depending on the yesterday's transaction, and based on that, it will be calculated. Another very critical part, we should keep that in mind, which I said in the technical part. LIBOR is a culmination or a summation of base, that is a risk-free rate, plus the spread, that is the credit spread, plus the margin of the 10 years. So all are taken into consideration. And then it used to be, most of the time, it is a simple interest. But whereas alternative risk-free rates are base rate, which is the risk-free rate, which is spot rate, that has to be compounded. Whereas generally the margins and the spread, which will be out of the spot, will be a compounding interest in some cases, simple in some cases. Base rate also will be compounding in some cases, simple in some cases. For example, SOFR will be a simple in some cases, but some so it is, and in Sonia will be compounding, or a Eurostar will be compounding. So it is at this moment, as I said starting off my session, that this is a very live subject, and these things are taking shape now. It is not coming by a regulator because obviously it's a market benchmark. So market has to evolve on this. So it is market conventions which is deciding all these things now. So it's, you people are in the right time when a major change is happening in the financial industry. And you people are noticing that. So that's why I'm saying there are a lot of options are coming that for risk-free rate, whether it can be compounded, whether it can be simple interest. For example, now another point I'd like to share here, because we can go in detail, I can speak on this subject for hours, but we don't have much time. But I would also like to say that there are some of the legal jurisdictions like France and Germany, even Mauritius, their government does not allow compounding of interest because that goes against the human rights to some extent, because compounding always add up the interest rates in a bigger way. So you need to follow a simple interest rate part of it. So some of the countries, wherever we are talking about compounding, the legal jurisdiction is also creating a problem. So some of the amendment has to be done. So there are challenges coming, but those challenges has to be taken into consideration and move ahead. So that's why I'm just trying to say that ARR is backward looking, LIBOR is a forward looking, and it relies on actual transaction rate, whereas the LIBOR, it works on the various, it's basically a judgmental quotation. So as I said in the earlier part, LIBOR has all the three things: the risk-free rate, term premium, and bank credit part. Whereas risk-free rate is this. So that's why I said you cannot just plug in the risk-free rate from 3rd January. in place of LIBOR. It will not give you a correct valuations. It will create a havoc there. So you need to remediate that part. So what you need to do, you need to come out with the credit adjustment spread, which is being done now to some extent. Bloomberg is providing a credit adjustment spread. And you need to come out with the term premium. At this moment, all these rates does not have a very liquid term structure like what LIBOR is to have. Like what LIBOR, as I said, you have a different terms, 0, 1 day, 6 days, blah, 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 up to 12. Spot risk-free rates does not have that at this moment. Now they have started creating it, but it's absolutely illiquid. Like for Sonia, Refinitiv, that is earlier it used to be Reuters, now it's called Refinitiv. They are coming out with a term structure, but absolutely illiquid, and because it's a new curve, and it takes time to make this liquidity. So that's the reason why we need to come out with the new credit term structures at this moment. So all these challenges are there, and all banks are struggling with it because deadline is not far off. So they are trying to create some synthetic curves on the existing markets, like for credit adjustment. One of the synthetic curves can be overnight index swap curve. From there, you can come out with the credit adjustment spreads, which can be plugged into your risk-free rate. So at least you have then this part, which is the risk-free rate part, and also you can get some part from here. Although you'll say, Chiragra, why are you saying this? Because Bloomberg is also giving, Bloomberg is giving the rate, but I'll give you an example where adding that directly, it's creating some sort of imbalances in the portfolio. So the problem here comes here is that the valuations of any financial products, whether it's a bond or it is government securities, which is linked to or derivatives, which is linked to floating rates, the concept was till now is that we used to always forward looking. So if I'm doing a product, let's say any bond, which is 3-month LIBOR linked, so I know what will be the 3-month LIBOR as on today. So I can fix that rate. That okay, for this, if I issue this bond after 3 months, today's 3-month LIBOR is 1%. So I know it will be 1 plus something which will give. So I can fix the rate today itself for this period. But whereas the risk-free rate is more in arrears, it's not in advance. So I need to wait till this date to get the rate. So that's creating some sort of a problem because, and that's also creating a problem in the payment and settlement system. And hence, the new way of calculation has come into the market, which is called a backward shift observation, backward with observation shift, backward with non-observation shift, look back, and so many calculation methodologies have come, which it's used now will be used in your calculation for interest accrual as well as for valuations using the risk-free rate. So that's the difference. Here it is becoming very cloudy. We don't know what will be the rate. Here we used to know the rate earlier. But slowly market will be going towards the risk-free rate. It will become much more liquid. At the same time, it will be much more safer compared to LIBOR because it is based on the actual transaction, and it is mostly by the central banks, at least those 5 currencies, major currencies. How much time I have? Okay. So this is, I was talking about the forward-looking rates, and at this moment it is not there, but very soon you'll see, maybe in years' time or 2 years' time, it will become more liquid. Now the market is working on that. And the credit adjustment spread, this the Bloomberg screen, you can take it. I've given the link so you can see the credit adjustment spread from the Bloomberg. But here the example which I was talking about. So if you want to take, let's say, the SOFR, which is dollar-based, and you have calculated the term of 1 month SOFR, 3-month SOFR, 6-month, and 12-month, and these are the rates. And this is the credit adjustment spread which you have taken from Bloomberg. When you add this up and you compare with the existing LIBOR, see the difference which is happening. LIBOR is at 0.28, whereas 12-month SOFR adjusted with spread is 0.78. So there's almost a difference of 50.50. And that's the negotiation which needs to be. That's why I was saying you cannot just plug in the LIBOR and this, and that's remediation, which is we are all working with, and how to adjust this differences. Otherwise, there'll be huge amount of differences if we just plug out LIBOR and plug in SOFR or any risk-free benchmark of those 5 currencies. Same thing, if you see 6 months, also there's a difference. 3 months, there's also difference between LIBOR and the adjusted credit spreads with for SOFR. So I was talking about this, the interest methodology, calculation methodology is changing now. It is no more in advance, it will be in areas. And there are various options coming into picture, which is the compound interest, compound the balance, compounding rate cumulatively, compounding rate non-cumulatively. And the difference are many. I am not going at this mathematical session at this moment, but there are various differences are being used, and which is becoming very interesting for all the core banking systems, because they need to come out with these options, because most of the banks, if they have a foreign currency loan or a foreign currency deposit or a foreign currency bond linked to LIBOR, that will get remediated to these risk-free rates, and all these calculations has to be done based on that for interest accruals. So there are quite a bit of changes are happening. I'm just throwing these ideas to you because I know in 45 minutes you cannot talk about the entire LIBOR transition. But just throwing these ideas, if you're a fresh student, you should start thinking on these lines and start reading about it. If you are already experienced in LIBOR transition, you can grasp this part quickly, and maybe we can have a discussion on that in today's after finishing my session, or maybe I can leave my email with you. You can always write to me. So the impacts are coming in a bigger way when this LIBOR is going, and it's coming in a bigger way to the various banks. So one of the impact is definitely on the governance structure of the banks, because governance, the board, the senior management, everybody has to know about the new risk-free rates. They should be well versed with it, because if the risk-free rates hits them in a bad way, when LIBOR goes and the risk-free rate with the adjustment comes in, if it hits in a bad way, that can impact their capital also. So depending on which jurisdictions they are based in, they need to be very careful on those risk-free rates, how they'll be. So impact on the governance structure, impact on the financial product big time, because all financial product which is floating in nature, which is linked to foreign currencies, will be impacted in their valuations. So some maybe, as you've seen, if you are a buyer, you can have a hit in the base way. If you're an issuer, you can get hit in another way. So whatever is the scenario, but all financial product which is linked to floating rates, that is LIBOR, and which is in foreign currency, will get impacted from 3rd December. So the remediation is required on that. The impact is also there in a big on a communication strategy, because this is genuinely a problem, because when you are a client of a bank and you have an investment based on LIBOR, or you have a loan which is taken based on LIBOR, or you have kept a deposit which is linked to LIBOR, you would like to know from banks that what they are doing on this. And if the banker or the relationship manager are not well versed with what is happening in the risk-free rate, you may be pissed off. And if you're a big client, you may sue the bank for it. So from a bank's perspective, this communication strategy is becoming very important, that how they are talking to the client, how they are talking to the regulators, how they are talking to the risk management and rating agencies. So communication is very important, because I know a case which has recently happened to one of my clients, which is one of the bank in South Africa, that they were not so prepared with the communication strategy. And the treasury person, and one of the big corporate which has a derivative which is linked to treasury, another has a loan which is linked to the loan book. And these two relationship managers spoke to the same corporate in different language. And this corporate was pissed off, and they sued the bank for giving a proper not proper answer for particular thing, and which is called a conduct risk and lead to a legal risk. So communication strategy is very important, because this transition is happening, and this transition should be properly done, so that, because anybody who makes loss will not be happy. So that needs to be taken into consideration. Impact on the risk management, very much, because your market risk benchmarks are changing. So obviously it will have an impact on your VAR model. It will have an impact on your limits. It will have an impact on your portfolio. So impact on the risk management is there. And the biggest challenge which is coming up is the impact on the IT system. Because most of the core banking, like whether you talk about Finacle, you talk about FlexQ, whether you talk about Temenos, T24, any big core banking system, they are used to the LIBOR system. But now this completely has to change to risk-free system, risk-free rate system. And what is the big thing? That the data structure, the data warehouse or the data lake, that has to be changed in a big way compared to what used to be for the LIBOR. So all this the core banking system, as well as the treasury system like Murex, and they are all changing their system compared to the risk-free rates. Although they're all running behind time because 31st is not far off, but all are struggling quite high. And that's why I thought to raise this point with you all and in this forum, that you should understand that what are the challenges which is there when the LIBOR runs. Because if somebody says that, okay, LIBOR is going on 31st December, very good. So what will happen? So somebody will say it will impact only the derivative parts of the treasury. No, my dear friend, it will impact foreign currency loan. It will impact foreign currency derivative debt. It will impact foreign currency deposits. It will impact any liability, any asset which is linked to floating rate and which is linked to foreign currency. So, and since it will be linked, these products will get impacted. So it has to be captured into the system. So the system will get impacted because they are not using this database. So that has to be amended. It has to be narrated properly to the outsiders. So the communication has to be impacted, it will be impacted. And all these pillars comes under the governance structure. So obviously governance will also get impacted. So it's a big transition which is happening, and we should all be aware of it, because this transition will also give a lot of opportunities to the students like you, because obviously this transition deadline is 31st December, but it will go a long way and people will be required for various type of jobs to do that. So every transition, every challenges are important because it brings a lot of opportunities, I believe. It is so true for me because as a consultant, I am working with various banks now in Mauritius, South Africa, Germany, Egypt, Middle East, where we're doing the remediation work for the big banks. So that's a lot of opportunities here. So I just thought, why not share this with you all? Last, before I finish this, I would like to touch upon what, excuse me, what Reserve Bank of India's views on this. And I strongly congratulate Reserve Bank of India because they have always thought ahead of time. And I was talking about this is the 8th July guidelines, which has come out. And it says that, obviously, what I said, that the banks has to take care of the LIBOR transitions. They need to take care of their contracts. They need to take care of the IT system and blah, blah, blah. But it also had a MIFOR, which I was talking about. And the MIFOR was, which is getting remediated, but marginally, because MIFOR itself was based on transactions earlier, which was created earlier. So MIFOR will also get changed, but not much, marginally. But the best part is that we should all be proud of it, that what Reserve Bank and other market players in India thought, now the rest of the world is thinking about it. So this reform came quite early, and the MIFOR rate, which is basically the Mumbai interbank forward outright rate, was based on actual transaction, and based on that, they used to come out with it. It's not based on any perception or anything. So now they'll have a MIFOR adjusted rate, because obviously the dollar is changing, SOFR is changing, so it need to change because it is based on the INR dollar rate. So obviously some marginal changes will be there, but RBI and Financial Benchmark India Private Limited, FBL, are ready with it, and they have already come with the guidelines. So the banks need to adopt this in their system, in their product, in their communications, and start working on that. So that's the RBI's view on IBOR, which is also absolutely bullseye. They have done a great job quickly before that. So that was the part which I wanted to talk about it. So before I wind up my session, exactly I've taken 45 minutes. This is a summary of the risk-free rates, which will be there with you, and you will be working with them on a regular basis. You can see that the summary part. This is the Euro USD LIBOR, which is good so far. As I said, all this I had already talked about it, but these are the risk-free rates, which will become the benchmark rates for you going forward. So I stop here. This is my email, and wherever you feel like, anybody feel like, you can always write to me. I stop here, and I would love to get questions so that we can discuss this topic. Thank you very much. If you have any questions, most welcome to take them.
Hello.
Yes.
Oh, hi. So we already have two questions in part. We have already answered both of them throughout the session, although I'll still reiterate both of these. And
Can't hear you properly.
Transactions of previous day rather than Hello.
So can you repeat what is the question? I can see the question.
Yeah. Yeah.
I can't hear you, Raj.
The question.
So sorry, I lost you. I couldn't hear you. I read the question. I think I've already answered the first part. And the second part is very important question about the derivatives. That's a good question, which is the risk managers are trying to do the mark-to-market simulations based on the alternative risk-free rate. But just to extend that question a little bit more, I think you have touched the right pulse, whoever that has asked that question about derivatives. One is the valuation part, definitely, which is important, and they need to do a simulations with alternative risk-free rates and see how the valuation impacts. Second is they will also get impacted if they're following hedge accounting or IFRS 9 accounting norms, because as for them, it was Libor was sitting on both the sides, so it was an effective hedge. But now this will have a problem because the benchmarks will be different, and they may not be considered as a effective hedge. So you need to come out of that hedge and do the valuations of both the products separately, that is derivative as well as the underlying bond or whatever it is there. So valuation is also getting impacted, as well as the hedge effectiveness will also get impacted. So obviously risk managers need to look into this well in advance from now and take a position whether to unwind the derivatives or continue with the derivatives. It's depending on the strategy they want to take it. But to answer your question, yes, both will be impacted, the valuation as well as hedge effectiveness.
Sorry to interrupt, Dr. Chiragra. I think voice is cracking a bit. So,
can you hear me now?
Mic issue from your side? Yeah, yeah. But in between, I think we couldn't hear you.
Yes.
Okay. So so let me know from where you have not. So do you need to repeat something?
I think for the answer bit, you were fine.
You're breaking off. I can't hear you.
I think you're breaking again.
Yes, even I can't hear you. Sorry for that. I think I've replied the question.
If you, yeah. So if you don't mind, you can try switching off your video so you can have a better bandwidth.
Sure.
Maybe that will help.
Sure.
Yeah, I think now the internet's going to be a bit more.
Great.
So, sir, I had my own personal question, if you don't mind. Audible?
Sorry. Can you hear me?
Hello. Am I audible?
Yes, you are.
Yes. Yeah. So my question was more specifically towards the, let's say, macroeconomics of Libor. So I wanted to know, why do markets have this general tendency of moving towards this, let's say, overall anchors? So let's say Libor or Sonia or any of these generally followed indexes to price their securities. I mean, in general, from what we have studied, it's like most of the times different parties will have like a certain set of risk profile, etc. So why is it that Libor becomes so important?
Great. Libor becomes important because Libor is the benchmark for the market. So as you rightly said, different parties will have a different risk perception. And that's why, depending on the counterparty's risk, you need to add the spreads or the margin. So you will add the spreads and margin on what? You will be adding the spreads on margin on a certain benchmark. Like, for why do you require a Sensex or why do you require a Nifty? Because those are the benchmark for the market. Because you cannot track each and every participant in the market. You cannot track each and every equity in the equity market. That's why you require an index. So same here is the LIBOR is the benchmark for the interest rate of the currency market. And depending on the market credit perception of the counterparty, you will add a margin. So that's why you need to, for any valuation, you need a benchmark. Otherwise, everybody will have a very segmented market. And if you have a very segmented market, the market will, because nobody will have any perception of the total market, where the markets are going. And you also need a benchmark because, as I said, from economic perspective, that you need to know how the interest rates are behaving. Because if everything becomes OTC, like one-to-one trading, becoming like I trade with you and you trade with one person, and we don't create any benchmark, then obviously it will be a very segmented market. So that's the reason we require a benchmark. And based on that benchmark, you will add whatever the credit spreads you want to add, depending on the counterparty's perception.
Right. Got it. Thank you. Yeah. Guys, anyone else has any question, you can please put them up on the Q&A box. Um, so we'll just wait for a few moments
Sure.
to see
No
if
problem.
anyone else has a question. And then
Yes, absolutely.
sir, I don't think we are getting any other questions.
Okay.
I'd request Maureen to give a vote of thanks and conclude the session. Firstly, sir, it was a really great and informative session. We'll probably be in touch.
Definitely, anytime.
Thank you so much for coming.
Thank
So,
you.
Maureen.
Thank you.
Good evening, everyone. Myself, Maureen Lisa, I'm a student at MDAE and I'm here to conclude the session. To begin with, I would like to thank our speaker, Dr. Chakraborty, for this webinar and enlightening us on history, importance, usage of LIBOR, and the key difference pointed out between LIBOR and ARR. It also gave us deep insights into the weekly review, cessation timeline, alternative and replacement rate, and also revealed some interesting facts about the forward rates. The point emphasized by Dr. Chiragra that this transition will impact the governance, any liability or asset linked to the floating rates, and revamping the IT system was fundamental. I am pretty sure this session has been informative and will help us understand the market better. Once again, I would like to thank Dr. Chiragra for taking time out from the busy schedule and for this session on the LIBOR Transition program. Finally, thank you to the audience present here for making this webinar engaging. Thank you, everyone.
Thank you so much. Really appreciate this. Thanks a lot for inviting me.